Welcome back to Financial Fortitude, the podcast that helps high earners, families, and business owners live well today and plan wisely for tomorrow. I'm your host, Michael Acosta, joined by my co-host, Brady Hemmerly.
Today, we're diving into one of the most emotionally charged and financially misunderstood topics. Should you buy a home or keep renting? Whether you're a first-time home buyer or someone weighing whether to stay put, this episode will unpack what really matters in that decision.
We're cutting through the noise. No more buying is always better, or renting means throwing money away. Let's break it down with real math, real strategy, and real life in mind. Welcome to Financial Fortitude, a podcast for high earners, families, and business owners. We're your hosts, Michael Acosta
and Brady Hemmerly. Each week, we bring purpose-driven financial guidance to you so you can be assured you're on the right path. If you're looking to become an extraordinary wealth builder, let's dive in. Michael, I am super excited to jump into this episode, as what really prompted this conversation was just an organic discussion that we were having amongst each other and amongst a variety of different people on our team. And we had gone down a bit of a fork in the road in regards to renting versus buying. And we said, you know what? We might as well make an episode out of this. So,
yeah, this couldn't be any more organic conversation or even topic for that matter, just because of how it kind of came about, right? Just sitting around in the office and somebody saying, hey, when does it make sense to buy a home, or when's the right time? And you and I immediately, like prairie dogs, just perked our heads up, and we each had just completely polar opposite points of view, which again, I think it's going to make for a fun episode, but also provide some insights that share, or at least shine on the fact that, again, there's what's rational, there's what's reasonable, and this decision isn't what I would say evergreen to where it's the same for everybody.
So let's give the listeners some of our maybe personal background, and I may even call it biases in regards to our feelings on the matter. So I guess for my personal background is over the past 7 to 8 plus years of work, I have been a consistent renter. I haven't yet to truly buy my own first home, and I'm sure we'll get into the reasons why and my thoughts there. But that's where I come from, is, hey, I've always been in the more renting mindset until it's time to buy a home. And I haven't jumped into that part of my financial journey yet. But provide the listeners a little bit more as to what your experience had looked like, probably before you bought your home, during, and then now after.
Yeah, so there's probably about a 5 to 6 year age gap between you and I. So been in the workforce a little bit longer, right? Had a little bit more life to live, experiences to be had. But I bought my first property in 2015, and it was a 1-bedroom, 1-bath condo in the heart of the city. And that was after being out of school, after, college for a couple of years, having multiple roommates. I think at one point I had 3, another point I had 2. And I just got to a point where I was like, hey, I'm now at a point in my career, 25 going on 26, where I just want my own space. I want my own area. And I didn't want to rent because, one, for the amount of rent I was going to pay in that area, it just made sense for me to go buy a property. Now, interest rates were, I'd say, relatively close to where they are now. I think my interest rate on my first property was like 6.875. Right now, they're hovering between like 6.675 and 7.25, right? So not astronomical difference there. But what is a lot different is the price in homes themselves, right? That's accelerated significantly over the course of the last decade, especially going back to like 2020 at the start of the pandemic and through the pandemic. And a lot of that's being driven by supply and demand, right? Some of that's also geographical location, with us being in Charlotte, North Carolina, where there's a ton of transplants coming here every day, more or less.
So let's unpack that a little bit in regards to where you started. So you're living with roommates for a few years. You get tired of roommates after a few years. And now the opportunity to buy a home comes up. Tell us more about what you were thinking during that time frame. Were you thinking more financially, or were you thinking more emotionally, or perhaps a mix of both?
I would say it was a mix of both. And I had my mother in my corner being my champion, my cheerleader, pushing me to get out of my comfort zone, because at this time I wasn't making a ton of money. I had federal student loans that I was dealing with, and just trying to figure out this whole adulting 101 thing. And so when I went through the idea of purchasing a property, I was thinking, okay, well, how can this have multi-purpose, right? Because I know this first purchase isn't going to be my forever purchase. If I planned on getting married, didn't see myself living in a 1-bedroom, 1-bath condo. Maybe for like the first year of marriage, but definitely wanted to be able to expand, have space, and knew I wanted to start a family at some point in the near future. So it wasn't going to be my forever home. And so my immediate thought was, okay, well, if I'm not going to live here forever, how can I monetize this? How can I make this purchase actually work for me versus it just being a sunk cost? And that's where I think I saw, okay, well, I can go rent in one of the popular areas in Charlotte at the time, which was, South End. It's still very popular today. It's where a lot of the young professionals want to live because that's where all the scenes and happening is, as well as Uptown at the time. I looked around different areas, looked at a bunch of different condos, had a great realtor who was basically helping me from a real estate investment perspective, saying, hey, if you're not planning on living here long term, think about who you might try to target as a tenant if you're willing to go down that path. And then also being naive and of the mindset that, we've been taught, it's been said that owning a home is the quote unquote ultimate American dream. And it's a way to create some stability because you at least have a place that you can always go to that's quote unquote yours in some form or fashion, especially once you have the mortgage paid off. But it should in theory be appreciating over time more often than not.
So what you found was, hey, I'm buying an asset emotionally in some capacity to get away from my roommates, but then an asset that I can live in. And then at some point in the future, unknown as to when, just depending on how life had shaken out, at some point, an asset to monetize truly and turn more so into an investment thereafter.
Yeah, and I've monetized it, I'd say, on multiple occasions. I've done short-term rentals when interest rates dropped in 2020 through 2022, refinanced it and did a cash out and was able to get my interest rate on my condo, which is a rental more or less, at the same rate as my primary residence, which is almost unheard of. It's sub 4%, which means that, right around inflation at a healthy rate. And so it's very convenient in the sense that the mortgage is relatively low, right? Making all things equal. And it just continues to appreciate because of the area that it's at. And people want to come visit that because when they come to Charlotte, they want to go to the concerts. They want to go to the sporting events. They want to go to the nightlife. They want to see family, whatever it might be. And in my opinion, a little biased, it's quaint.
So tell us then, surprises or things you learned, the good, the bad, and the ugly, over that first purchase?
Yeah, so the first year is the most uncomfortable year because one, as a young professional, again, 25 going on 26, you have to come up with a down payment of some sort, right? Whether it's 5%, whether it's 7%, whether it's 10%, definitely wasn't 20%. And it's hard to find that balance between taking all this money that you saved up and committing it to that while also trying to figure out the demands of contributing to a 401k, paying student loans, wanting to be social and have a nightlife, like all those demands. So it was very uncomfortable. And I just remember my mom telling me, you'll figure it out. It was like, great. I mean, I will.
You're certainly correct, Mom, but thank you for the sage wisdom there. Right?
Yeah, and that's really kind of the mentality is that you'll figure it out, right? Like, I mean, you're not going to allow yourself to fail. It's kind of the mindset you have to have, but I try to take that and share that with other clients who are going through that experience of buying their first home, because one thing that was never really disclosed to me during that buying process, and I don't put this on my realtor or anything like that, but it was more like no one told me how expensive that first year of homeownership is. And it's because, again, the down payment, the closing costs, going and buying furniture to fill out certain areas of the home, and constantly trying to find new things to make the space yours, right? You want to make it homey. You want to make it inviting. And so that can be costly up front. And so just emphasizing, hey, your first year of homeownership is going to be very uncomfortable. You got to get used to your utilities, HOA if you have one, property taxes, like all these different things that go into quote unquote adulting 101. And once you make it past that first year of what I would consider homeownership initiation, it really gets easier. And then what's even more exciting is when you start to see over time, you won't see it very quickly in the first, call it 5 years, but your mortgage balance starting to go down and your home appreciation and value going up. And so in simple form, you have equity that's building up in this property. It's just not very liquid.
So I guess the last question that I have then is a lot of surprises in the first year, a little bit of discomfort in the early stages of owning the property. Tell us how, from an emotional perspective, it made you feel now that you no longer have roommates, you do own something of your own, despite all of the discomfort that you're feeling at that time.
I felt very empowered, and I felt an additional layer of independence. like when you have roommates, you're obviously independent, right? You don't have to ask permission to go do things. You can spend your money however you want. You can have people over for the most part whenever you want, assuming it's not going to annoy your roommates. But I didn't have to worry about people coming in at all crazy hours of the night or the day, interruptions. If I'm trying to work, if I'm trying to focus on something, you do miss out on some of the social aspects of having roommates, which is nice, right? They're usually always being someone to talk to or hang out with or just kind of shoot the breeze with. But again, by this point, wasn't problematic for me to just hop in my car and go visit a friend or hop on the light rail and go to a social area of town. But for me, it was more like, hey, I'm on this like growth focus. I'm trying to continue to level up, and I don't want to be stagnant. And hindsight, I wasn't really focused on what a lot of millennials and young professionals, and I would even say families in general, are having to deal with today. Is am I going to be priced out? Like that wasn't even a thought of mine, but it's becoming more and more prevalent in cities, in certain areas geographically across the country where, hey, people are getting priced out because of the rate at which homes are appreciating and incomes aren't appreciating at the same rate. And so that's almost problematic in itself. And I had a conversation with a client just the other day who lives on the West Coast. It's a second purchase that we'll be going through. The first one wasn't enjoyable, but the concern now is that, hey, we've relocated to a more affordable area of the state that we live in, but it's growing at an accelerated rate. They're redeveloping certain areas. And the concern now is, hey, price point to get back in is relatively close to what it was 2 years ago when we first bought in a different area. And we feel like we're being priced out already.
I would say that is the consistent challenge of the renter who's maybe waiting in the wing ultimately to buy their first home.
And you're waiting in the wing for the perfect time to be able to jump in, right? It's almost like going to the pool and not wanting it to be too cold but not too hot when you jump in. And unfortunately with home ownership, like my personal bias on the matter is that it makes sense to buy a home if cash flow permits and you're not planning on selling the home before you at least reach your break-even point, right? Which on average is probably going to be somewhere between 3 to 5 years when you hit your break-even point. What I mean by break-even point is all the money that you've had to put towards the purchase of this home is accounted for, but actually becomes cheaper longer term than you continuing to rent. Now, Brady, I've given my backstory and my bias and my perspective and experience on home ownership and kind of what led me there, both from a technical perspective, but also an emotional standpoint. I'm curious to hear your stance on where your reservations stem from and what your experience has been having roommates and what's kind of kept you on the sideline trying to figure out that perfect timing situation.
Sure. So for my background is I came to the city as a young professional in similar fashion to yourself, was not an extremely high earner right away. And I had the luxury of having two roommates that I enjoyed spending time with, that were very good individuals to live with. And as we combined our efforts, it made rent much more affordable, at least compared to buying early in our journeys. And so the approach, at least that I had taken to the start of my career, the start of my financial journey, and just where my life was at that time was, I'm not sure how long I may be working with this particular company, because this is not my forever home in the workplace. I am not sure whether I'll love this city or not. Originally, I'm not from the Southeast, so in my head was thinking, well, I hope it works out. I hope I can grow and set roots here, but I'm not sure how long I may or may not be here. And I don't know what my life is going to look like 3, 5, 10 years from now in really any capacity. So buying to me felt like a very high commitment decision, especially as you mentioned, there's not a lot of capital, or that first year seemed really expensive as a homeowner. So the approach that I had taken and still have continued to take in some form or fashion up to this point is, why don't I continue to rent as long as the rent I can find is reasonable for the area that I want to live in, and I will use all of the rest or the excess of my dollars from my salary, and as my salary's been increasing, and essentially invest the difference. And the thought process there is, hey, when I know I'll be in a place long term, I'm at the career location that I want to be long term, and I'm ready to make that big emotional decision, over the course of 3, 5, now getting closer to 10 years, I'll have all of the capital set aside to perhaps purchase that forever home, if that's even something we want to do at that point.
I think a lot of young professionals and families go through that, right? And again, some of it has to be emotional in essence. One of the emotional elements that at least I'm understanding is that there's this element of the unknown. How long am I actually going to be here for? Right? How long am I going to be in my actual job? And I think that there's prudence in that. Because again, if you're not going to be in the home long enough to get to a point to where you break even, at a point to where you sell that property, which again has to be, in most cases, somewhere between 3 and 5 years, best case scenario, and you're not planning on flipping it into some sort of rental opportunity, then yeah, buying a home just isn't a wise decision, right? And these are things that we often will discuss with residents and fellows who are going to a new city for training for 3, 4, 5 years, and then flipping to another city and hospital system for another 1 to 2 years. And it often comes up, well, we don't want to rent, based on the rent, it's probably the same amount if I just buy. The problem though is that you do have to have some sort of due diligence around the technical analysis side of it, right? Am I going to be underwater when I sell it and I finally get that attending position job and I'm maybe relocating to another place?
Yep. And I'd say where some of the personal renting bias has stemmed from is early in my career, I saw many clients who perhaps overpurchased or took a step up to the plate on a home that was maybe a little too much, and it was eating up or taking away a lot of their cash flow. And cash flow in this instance translates just directly to lifestyle flexibility.
Yep.
Some of that bias stems from, hey, I'm not really ready to make a large, longer-term financial commitment at this point. If I want to move, if I want to take a career risk, if I want to take an investment risk, I want to have the capital set aside to do it rather than all of that capital or most of that capital be locked up in a home. So from the emotional side of things, at least on my end, the thought was, hey, I'd much rather have money in my pocket and have the option to buy a home rather than buy a home. And then there's a big question mark around how much money will I have in my pocket when that next opportunity comes or when that life change comes.
Right. So that poses a question that I have for you, right? Because we often hear this idea across various areas of financial services, financial planning, financial strategies of, hey, we're going to do one thing and we're going to save the difference. We're going to save the delta. Otherwise, would have been paying for that other opportunity. Opportunity cost, more or less.
Mm-hmm.
So of your peers who have a similar mindset, of the clients that you've engaged with that have a similar mindset, how many of them, and you can throw yourself in this stat if you want, how many of them do you think successfully execute the strategy of renting and saving the difference?
This is a pointed question, perhaps even a loaded question. I think the true answer is very little, which is why there is so much historical bias in owning a home is the easiest path or one of the main paths to build wealth. And this is where I think you and I differ as we dive more so into the math here in a couple of minutes. But is renting and saving the difference the best or better option? The answer is always going to be it depends. But what you and I well know is that most individuals, most clients are more, maybe not incentivized, but are more likely to spend the difference.
Right.
Which quickly puts rent in the spotlight of being the worst choice. Now, what does that essentially mean is, hey, if renting is the primary plan, and if saving the difference is the financial path to equal or better success, it requires an extreme level of discipline. You have to save the difference and you have to invest the difference, not just in a bank account.
Yeah. Well, and you also have to do the due diligence to identify what that difference actually is.
Yes. Yep.
Right. So you do have to do some investigative research if you want to execute it right. This is a personal question, so you can plead the fifth if you want. But you've been in the Charlotte area for now, what, 7+ years?
Yeah, 8 years now.
8 years now. Okay. Do you feel like you missed the train on an opportunity based on how the home prices here in this local area have appreciated over the course of the time of you arriving and where you are today, based on areas that you would like to potentially live in and start to build a longer term opportunity for yourself? And do you have the capital saved up for that execution purchase, right? You don't have to go into like the details of the amount that you've saved up, but do you feel like, based on what you would put down, if you identified the right property, do you feel like you're in a position to execute that if you want to? Because that's what you emphasize, is that I would rather save the difference. And if I want to buy a home, I have the flexibility to do so versus feeling like I have to buy a home.
Yes. So I won't plead the fifth on this one. And it's a good question. Do I think I missed an opportunity? I would say yes. And I think that's how a lot of home buyers who were waiting in the wing, especially from, call it 2018 to 2022, a lot of home buyers feel, yes, I did miss an opportunity. Interest rates were very low. Home prices had not run up yet. If I had bought a home 3, 4, 5 years ago, I certainly would be in the green at this point, right? I'd probably be much beyond my break even. Now, does that missed opportunity something that upsets me or something that I have regret over? Surprisingly not, because hindsight is always going to be 20/20, right? I understand that I missed an opportunity in the housing market, perhaps in my local area, but I also am well aware that I have taken advantage of the more recent market opportunity from 2018 to 2025. Over the course of the last 3, 5, 7 years, we've seen fantastic returns in the market year over year. And so I, at least personally, feel because I was disciplined in saving the difference, because I had a plan of action in place that was purposefully driven and regularly checked in on, I missed the housing opportunity, but I took advantage of the market opportunity. Now, do I have enough money set aside to step into my overall plan with confidence? I would say maybe.
Okay.
And I think this is the challenge of most homeowners sitting and waiting in the wing is, well, the opportunity or the home that I would have bought 5 years ago is not the same home that I now am considering buying. One, appreciation has gone up, so the home I would have bought 5 years ago is more expensive. And the home that I would have bought 5 years ago is probably not the same home that's going to fit my lifestyle needs. Right? I have a significant other. Marriage is probably around the corner. Kids may or may not be around the corner. Right? And the starter home or condo that you first bought is not something that is going to fit my needs anymore. I may be looking for a more traditional 3-bed, 3-bath or something a little bit larger. So do I have all of the money saved up? The answer is maybe. It just depends on what area it's in, what the price is, how big of a home we may be looking for, all of those different things.
Got you.
Now, here's what I will say. If I was not disciplined and didn't save the difference, I think I'd feel much more regret about missing the housing opportunity because I would not have taken advantage of the market opportunity.
Got you. Okay. Well, and one thing I do want to disclose as a homeowner and someone who's owned 3 different properties over the course of the last, let's call it 12, almost 13 plus years of living in the Charlotte area, you can still be priced out even in homeownership. So my wife and I always had the idea of, okay, well, we're going to move out of our desired area to start our family for 3 years and then work our way back into our desired area. Well, one thing that happened over that 3-year span was significant home appreciation as far as just real estate values in the Southeast. And so now the conundrum is, okay, well, I have this great equity in the property that we've owned, since 2018, heading into 2019. However, because of where interest rates are now, because of where my primary mortgage interest rate is from when we refinanced it during historical lows, if I sell my property and roll it into another property, well, I'm basically getting a home that's not a step above where I'm at today, right? Not saying that I need more, not saying that we want something better, but to be able to step back into an area of the city that we would want to be in, we were getting a lot less square footage for a significantly higher price. Maybe not nearly as much lot premium for the kids to roam and play in, but what you gain is proximity. Even for me, there's this internal struggle from an emotional standpoint. It's like, okay, well, nothing is forcing me to move, but I also feel like I'm getting priced out to be able to get back to what our original goal was moving back closer towards the heart of the city.
And I think that's the largest or most challenging consideration in this whole argument, right? Is in many instances inside of our 401k, inside of our investment account, with any money that we have sitting on the sideline, we're much less emotionally attached to the stocks that we're buying, the bonds that we're buying, the choices that we're making in our investment accounts, because all of it's on paper. But we are much more emotionally attached to the decisions we're making about a primary home first and foremost, but really any piece of real estate that we're buying, because there's always an emotional attachment. It's much more challenging to make a decision looking at, hey, should I buy this primary home, only considering the numbers? Because if we only consider the numbers, we could run them quite easily and say, this is a better purchase now, this is a worse purchase now, this is not even a purchase now financially. But the challenge, as you mentioned, is saying, hey, I don't need more. I don't necessarily want more, but wouldn't it be nice to be a little bit closer to my office, a little bit closer to the city? Wouldn't it be nice to feel like, hey, I have better flexibility in my commute? Any of those things. And it's super meaningful, but you can't put a price on that stuff, right?
So let's go ahead and dive into some of the numbers. Let's get into the technical side of this where we get to geek out. I want to point out a couple of stats. I think it's important. So one article that I went and did some research on, because again, this is more or less a debate, right? Because we have two opposing opinions on this. And so one of the things I wanted to understand or look at is, okay, well, how much have homes appreciated over the course of the last decade or 2 decades as far as rate of return? And so there is a site called Neighborhood Scout, and specific to the Charlotte, North Carolina area, it's showing real estate appreciation and housing market trends. And one of the things that it shares is that over the course of the last 10 years, the growth for average annual appreciation in this area has been about 10.09%. Now, when
that's when we see missed opportunities, right? When people talk about missed opportunities, yeah.
Yep. And it also goes on to say that this rate places Charlotte, North Carolina in the top 10% nationally for real estate appreciation during this period. Now, if we look at the last 20 years, and we go to a site called Wealthy Group with the article from June 24th, 2024, titled Charlotte Real Estate Prices Double in Just Over 5 Years, it shares that the approximate average annual appreciation is about 5.78%, and that this rate reflects a more sustainable long-term growth, accounting for various market cycles over 2 decades. So, one, the 10-year average, right, for the last 10 years is very similar to a return that most young investors are familiar with, right? Whenever we sit down with a young investor or young couple and we start talking about return expectations, it's very quick that they will say, well, the S&P 500 over the last 10 years is average, 10, 10.5, 10.9, 10.2%. And so in my mind, that's where it went. It was like, okay, 10.09%. That's very similar to the S&P 500, right? Whereas the 20-year return, 5.78, that just seems more realistic.
Or fair, longer term.
Or fair. Yeah, maybe that's a better phrase, more fair. So we're looking at the growth rate of owning something, right? Something that can appreciate for you, because the difference between buying a home and buying a car is that the home should, in theory, appreciate. The car, unless it's an antique, is not going to. It's going to do the opposite. It's going to depreciate the moment you drive it off the lot. The other thing that I went to look at was like, okay, well, what are renters actually paying these days? Because second or third year out of college, when I was living in a home in a desirable area in Charlotte with 3 other teammates from college, I was paying $425 a month, right? Like,
I think most people would kill for now.
Yeah,
right?
yeah. I mean, you can't beat that. And looking at some of these numbers, so I pulled an article from WCNC Charlotte, which is a news platform. Charlotte rent prices reach new record highs as most of U.S. finally sees relief. And it states that from 2021 through 2023, that rent was increasing by approximately 8% from May 2022 to May 2023. Over a 2-year span from May 2021 to May 2023, rents rose by about 16%, reflecting sustained demand and limited housing inventory. I don't have a longer term average. They also state in that article from 2015 to 2020, the increase was ranging in rent from about 5% to 7%. So I guess you could use that in theory as far as, the rate at which rent would increase on you. Doesn't mean that it's going to happen, right? I think in your instance, your rent's been relatively static the past couple years, which makes it even more attractive to remain in that element versus doing something different.
It all depends. The area that you're in, the size of the home or unit that you're in, and ultimately the luxury that you're living or lack thereof. I think my rent has stayed more static because we've strategically moved to areas that have not really seen strong appreciation when the time was right to do so. As areas started to get more and more expensive, roommates and I said, hey, we could live across town in essentially the same situation for the same rent rather than pay a 10%, 15% increase this particular year.
And the other thing that I want to know is, okay, well, we talked about the rate at which rent is increasing, but what are people actually paying? And so there's another article that I went to from Norada Real Estate Investments, the website itself, and it talks about average rent prices in America in 2024, a state-by-state breakdown. They give you an average across the nation for a 699 square foot apartment, condo, living space. And it came out to, I'm going to round up to $1,560 a month for one bedroom apartment. Okay. And they expect that to increase by, we'll call it, they said it was a 1% increase from 2023 to 2024 when just taking a national average. But if you go look at, because it denotes it in the actual article, if you go look at different cities, I'm just going to chirp off a couple of them. Boston, Massachusetts, average monthly rent, $3,200 to $3,500 a month. San Francisco, California, $2,800 to $3,200 a month. Seattle, Washington, $2,000 to $2,200 per month. Washington, D.C., $2,100 to $2,500 per month. Miami, Florida, about $2,750 a month. Austin, Texas, $1,500 to $1,700 per month. Denver, Colorado, $1,700 to $2,200. Atlanta, Georgia, $1,500 to $1,700. And then Raleigh, North Carolina, $1,300 to $1,600 per month. Okay. So pretty wide span in different cities. But again, geographical location is going to dictate what you might be paying to rent, basically paying someone else's mortgage versus you potentially owning something. But you also have to factor in, well, what's the average cost of a home in that area? So we're going to keep things in this technical analysis relevant to North Carolina and as close to Charlotte, since that's where we're at as a reference point.
Well, Michael, I would say all of those numbers that you shared, I would say are fair, especially those Southeast type numbers in regard, call it $1,500, $1,700, $2,000 a month for rent in a one bedroom is pretty representative of what we see in Charlotte. And then for friends, family, people who live in the Northeast or out on the West Coast, they're certainly paying more. But I'm most curious as to what a home purchase actually looks like in a similar area or to compare more similarly to renting.
Yeah, so I prepared for this, obviously, in my debate, right? I knew this might come up, knowing how my opponent thinks. And I said, okay, well, let me put myself in this situation. What would I be looking for aesthetically in a home? Well, in my mind, my bias is, well, if I'm going to buy a home, I want it to be something that's going to be attractive if I need to sell it or if I'm going to rent it. So at the very minimum, I want 3 bedrooms, okay? One for me and my partner, maybe a child, and a guest room. Also want 2.5 bath. Would like it to be in a relatively close proximity to the city to where I can get to and from the city within, we'll call it 20 minutes, 20, 25 minutes. And square footage wise, about 1,600 to 1,800 square feet. So according to Zillow and Rocket.com, the median sale price for a home in that range is going to be about $382,000 to about $425,000.
Any of our Northeast listeners are probably shaking in their boots hearing those prices.
Yeah. Well, and like the caveat to that, in my neighborhood where I live, there's a lot of folks from the Northeast who have, relocated. They're selling their home up there and coming down here and buying things in cash, which does not help the housing market for those here locally, right? So it's not that they're not taking advantage of, getting a couple extra months of warmer weather and also lower cost of living, but it's definitely starting to adjust the landscape for those of us who live here and who have lived here long term. So we have a purchase price. We're going to go with the lower end, $382,000, right? Because we're keeping in the mindset of the young professional, not overreaching. And one thing you brought up earlier is seeing young clients or clients in general who have been, and I'm going to phrase it 2 different ways, who are either home rich or home poor, meaning that they have this nice asset, but the eroding factor, the commitment, the demand on their cash flow is so high that they lose all of their flexibility by means of being able to save and commit to other areas. Maybe it's the lifestyle that's diminished. Maybe it's the way that they're able to save and invest that's diminished. Money's being redirected towards something that's not very liquid, but in theory is appreciating over time. So our rule of thumb is that if you're going to go buy a home, try to keep your principal and interest payment somewhere between about 15 to 18% of your annual gross income or 15 to 20% of your annual gross income. The CFP board recommends that your principal, interest, taxes, and insurance payment not be more than 28% of your annual gross income. So again, these are just rules of thumbs. These are guidelines. Take it for what you want. And we recognize certain geographical locations don't play well with those numbers. And that's okay. You shouldn't feel like you have to own a home in order to find financial independence, financial success. I think cash flow is a greater focal point when making this type of purchase. Are you going to feel completely suffocated from a cash flow perspective? Or are you still going to have quality of life and flexibility to invest and do other things, even if that means having to rent a little bit longer?
And that will probably be a conversation that your opponent brings up later. One of which in saying, hey, how do we balance the happiness that is driven by flexibility, options, choices, excess versus the happiness that's driven by the ownership that you have in a home?
So I said, okay, well, let's look at average rent. We went with an average rent of $2,000 a month, and we're using a calculator online called Rent versus Buy Calculator on NerdWallet. Okay, and we'll put it in the show notes so that anyone who wants to go play with it can. But basically, rent was $2,000, security deposit, 1 month's rent, renter's insurance, about $25 per month. Rent increase, we went with 6%, which we thought was relatively fair. Purchase price of the home, because we got to compare the scenarios, $382,000. Down payment, we said 10%, which would be $38,200. Term of the loan, 30 years. I'm a big fan of doing a 30-year loan and having the flexibility to pay it off over 15 years or less than 30 years if I want to, right? Because at a baseline, I at least have a lower fixed payment,
Yep.
Right? Which gives me more flexibility, because if you go up to the 15-year mortgage, you're going to have a significantly higher monthly commitment, less flexibility. Gave you graciously an interest rate of 7%, knowing that it could probably get a little bit lower than that. But, you try to help your opponents out when you can. Closing costs, I said 3%. Property tax rate, we went with 1.5%. Homeowners insurance, we said about $1,600 based on some research that we had done online. I don't have a specific source for that, just leveraging what I could find online as far as like an average. Didn't include any HOA fees, but I'm sure there are some. So if we want to throw that in on the fly, we can. PMI insurance, so private mortgage insurance, just under 1%. Utilities cost per month as an additional expense, $250 per month. Home repairs and maintenance, about 1%. Depending on the type of home you're purchasing, if you're getting a fixer-upper or new construction, will dictate how much in repairs and maintenance you're going to have to commit to. Personally, we haven't had a ton of them over the course of the last, we'll call it 6, 7, 8 years, but it comes up, so you can't eliminate that, right? But I do know, again, in that first year, if you have a yard and you're going to be cutting the grass yourself, you're probably going to have to go buy a lawnmower if you don't own one yourself and everything that comes along with that. So there are expenses that come up. Selling costs, we said 6%, typically 3% to the buying agent, 3% to the selling agent. And then the home appreciation yearly, we went with 5.78%, okay, based on some of the articles that we read and shared earlier in today's conversation. Now, as far as the individual who's buying this home, we said, hey, it's a single professional. Annual rate of return in the stock market, if they were going to invest the difference like you've been doing, 8% net of taxes and fees. And we said, from a marginal tax perspective, looking at federal rates, 22%. So just think about what those are and what type of income this professional might be making, over 6 figures, more or less.
Yep.
Capital gains rate, 15% if they're selling their investments. And we said general inflationary rate, 3.5%. So again, a lot of data points. Again, we're going to share this calculator in the show notes so that you can go and play with it yourself. And when we look at this, it shows us that the total cost after 4 years favors buying versus renting. The reason why it doesn't favor buying in the first 1 to 3, 1 to 4 years is because of the amount of liquidity, cash, capital that you have to bring to the table for the closing costs, for the additional increases in homeowners insurance versus renter's insurance, the down payment on the home, which is otherwise capital that would be able to remain in the stock market compounding and growing for you. The one thing that this calculator does not include, though, and you and I had a great chuckle around this, was, well, if homes are appreciating at 5.78%, if I buy a home that's sold for $382,000, what is that home actually worth at the end of year 4? Because where I'm going with this is, well, there should be some equity in the home if you decide that you want to do a cash out refinance, if you want to do a home equity line of credit, or if you want to sell the property and take the earnings and pour it into the next home and level up, right? So I said, all right, well, over the course of 4 years, if it increases at 5.7, not 5.78, you see how I continue to just give you a couple leaps up on me with this, being gracious? The home is forecasted to be, from a future value perspective, around $476,830. So almost grew over 4 years by an additional $100,000 in value. Now, why is that relevant? Well, I've been paying my mortgage for 4 years, and this assumes rates haven't dipped below, 6.5, 6, down into the fives to where maybe I want to refinance to a lower rate, which would make my cost each month even lower. But from an amortization standpoint, if I go and look at where my mortgage balance should be at the end of year 4, mortgage balance is around $329,000. And this assumes that we financed around $345, because again, we put 10% down on that purchase price of $382. So what does that mean? That means that I have equity in this property of a little over $147,000.
Yep. So from what I'm understanding through all of your numbers is that fast forward 4 years and all of the costs to get into the home have essentially broke even with all of the rent payments that you would have made over that time frame.
Correct. From a cost perspective.
Cost only perspective. And that cost still counts the down payment.
Right.
And then fast forward the 4 years and you now have $150,000 in equity of the home that you've owned at this point. My question to you is, based on all of those numbers, how much money do you have now set aside or reinvested or cash elsewhere that adds to your net worth? Because right now your net worth is right around 150, because that's what you have in equity in your home. What's your net worth outside of your home, if any?
Well, that's going to be a wildly wide scenario, because it's going to be indicative of the person in this scenario being able to save beyond that mortgage payment, right? And that's one thing that this calculator doesn't actually quantify. So the mortgage payment in this scenario, based on that price, was, just principal and interest, I'm gonna round up $2,300 a month. So just from a principal and interest standpoint, it's only $300 more per month than the rent that this individual would be paying. But of course, you have to add in, we'll call it $133 a month for homeowners insurance, which is typically escrowed, so you're not really seeing that. And then additionally, property taxes, which are accounted for in the escrow as well. So let's just call it another $250, $300 a month there. So all in, you're probably paying about $2,700, $2,800 a month. So an extra $800 for a mortgage payment versus $2,000 for rent.
The other question there is, have we baked in maintenance costs, cost of furniture, home repairs, all of those other things that come into making the space your own?
Yeah, so we didn't necessarily bake in the cost of having to go buy furniture or anything else, right?
Okay.
We also never denoted how much of a purse this individual had when making the purchase. Did they fully exhaust all their capital when they put the 10% down, or were they sitting on, $150,000 like a young professional who's been saving the difference for the past 8 years? Right? So it's so situational that we can't really say one way or the other whether or not it's better off or worse when taking that into account. Like, those are extra variables that just were not accounted for in the calculator and that the calculator doesn't present.
So let's run the numbers just for the sake of it. Let's say the young professional, when they bought their home, exhausted all of their capital.
Okay.
So right around, call it $40,000 is 10% down. Did I have that number right?
Yeah, it's just under 40,000. It's like 38 and some change.
And then we know the difference, based on everything you've shared up to this point, in monthly savings, if the renter is doing a good job and staying disciplined and saving the difference, is $800 a month.
Let's just round that and say $800 a month. Yeah.
Yep. And then let's give that the growth rate of, what did we say, 8% after taxes and fees? Where does that leave, after 4 years or 5 years, the renter from a net worth's perspective? Probably not going to look as great as 150, but...
So if we're saying that the original down payment of $40,000 plus the additional $800 per month, which comes out to $9,600 a year, growing at 8% net after taxes and fees over 4 years, puts the future value of that at about $101,000. So
Okay.
$49,000 less in net worth.
Sure. Yeah. So that's where we begin to see, hey, from a cost perspective, 4 years, we've broken even. All of our rent payments have equaled all of the internal costs that we put into our home, between mortgage, closing, all of that stuff. And we fast forward, and now the buyer in this instance has $150,000 in net worth or home equity. And the renter at this standpoint has $100,000, give or take, of net worth or equity, but in investments instead of their home. Now, if this was the case and we're in a vacuum and the buyer did not save any extra dollars, they have $150,000 net worth, but it's all inside the walls of their home. Whereas the renter in this instance, financially, they're a little bit worse off. They don't have as much net worth as the buyer, but the renter now has all of the flexibility in moving to a new city, taking a new job, taking more risk for an opportunity, buying a home of some kind. Now, obviously, it depends on how much homes have appreciated over that time and if it's the same math there. But that's where you start to see, as hopefully our listeners are, is the art versus science of this decision and then just financial planning in general.
Yeah, no, absolutely. Because there's definitely the psychological aspect of it. There's the behavioral aspect of it. And then there's just the math part of it. And one thing that we haven't talked about is, well, what's the taxability of any dividends or interest that you're receiving on your investments that have been growing at 8% over the course of the last?
But we said 8% was after taxes and fees, right?
Okay, fair enough. Fair enough. And from a liquidity standpoint, though, we would go and tell this individual, if we met with them for the first time after purchasing that home, hey, you have great equity in your home. Go ahead and set up a home equity line of credit. And now you have a purse of liquidity that you can tap into in the event of an emergency until you build up your emergency fund. So there's various levels of liquidity on one's balance sheet. Some are more liquid than others, meaning you can gain access to them a lot sooner. Not saying one way is better than the other. And I think we both agree heading into this, and we're waiting to the end to kind of share this, is that homes aren't necessarily a quote unquote investment. They're more or less a utility, in my opinion. And the reason why I feel that way is because the purpose of the home is to protect me and my family from the elements. It's to give us a home base to go back to and, make memories, have somewhere to eat as a family, watch movies as a family, create experiences, but also have something that's appreciating in value, that if there is a hard period of time, I have something that I can leverage. I can sell it and get capital in exchange and downsize and do something different. If I'm just, I hate to use the word just because it kind of diminishes the decision, but if I'm renting, I lose that availability unless I've been disciplined in saving the difference, which we've continued to harp on. Like, you have to save the difference in that scenario if you want a potentially better outcome than you taking on the stress of buying a home if you don't feel like you're ready.
And that's where the old adage of home ownership is the path to wealth really stems from, right? Is once you own a home, you are committed to making mortgage payments and effectively building wealth over time, which is great, right? Because you're forced savings into an appreciating asset. And if you don't do those savings, you get evicted from your home, right? There's not a lot of options from an emotional standpoint to make other than I have to pay my mortgage payment or I won't live here. Whereas the renter can easily say, hey, I have to make my rent payment to live here, but at any time, I'm not obligated to continue effectively saving this rent money. So the renter has a much more disciplined path ahead of them to build the same wealth that the homeowner otherwise would build in this circumstance. Now, the renter may have more flexibility from a liquidity standpoint, and that's where your opponent comes in his argument and saying, for me personally, in my emotional decision-making, my life decision-making, why I didn't feel a lot of regret in not buying a home, is if I was this person who had $100,000 at their fingertips to access, that makes me feel much more emotionally comfortable compared to the person who's maybe worth $150,000 but doesn't have any money in their bank account to leverage. Someone like me may have had the opportunity to move from a corporate role into a more independent role, take risks, start their own business or start their own world. Someone like me may have the opportunity to buy into a rental piece of real estate, to invest in the next exciting stock opportunity, to take their money and move cities or change careers again. Whereas the homeowner, they technically would have those same opportunities. They have more money. The challenge is they now have to make an emotional decision. Am I going to sell this home to actually realize all of the capital? Or am I going to borrow from my home and further leverage it to gain access to the capital?
Absolutely. And I've been saving this statement in my back pocket until the end. If you want the ultimate level up, the way that I think about it is I could be this individual buying this home. If I love the idea of still having roommates because it's a 3-bedroom, I can rent out the 2 rooms as a single individual. My monthly mortgage is $2,800. Average rent somewhere between $1,500 and $2,000. If I go and tell these roommates, hey, rent's $1,400 a month, that's less than the average rate in the local city for a less desirable situation in most instances. So not only are you saving them money, but now these 2 other people are paying your mortgage 100%, which means you get to save $2,800 a month from what otherwise would have been a mortgage payment, right? So we're just checking all the boxes of,
But
okay,
what you're telling me here is that you're going to set up another bedroom next to your kids' room for me to come live with you as the renter. See, I don't know about that.
Hey, I got a downstairs guest room that's all yours, no questions asked.
And do I get paid to babysit your kids when you're not there? How does that
We
work?
can deduct it from the rent. We'll figure that part out. But no, I think in all seriousness, again, it comes down to the art of it. It comes down to the emotional, psychological aspect of it. And what's the purpose? I think to summarize the conversation, and then there was a stat you brought up earlier in the prepping conversation that you and I had around just views of homeownership and how it's utilized in a financial plan from like the millennial vantage point versus baby boomer. And so I think it's worth sharing that before we wrap up. But to summarize, 1, you have to do your due diligence. Look at the numbers, do a self-reflection. What's the emotional drive or the mathematical drive that's pushing me to maybe want to own a home or want to continue to rent? Additionally, how long do I plan on being in this vicinity, this area, this town, this city? Doesn't have to necessarily be the job, although that's important because if you get laid off, then it might be very stressful having to do both, pay rent or pay your mortgage, as well as how is cash flow currently? And if I purchase this property, am I going to be completely suffocated out of continuing to be able to build wealth and hit that extraordinary wealth building status that we harp on, right? All that needs to be discussed. If you don't have anyone in your corner to be able to go out and do that, do some research and find yourself a financial advisor, someone who can help coach you architecturally on what your balance sheet looks like today, what your financial position looks like today, and whether or not it makes sense. And then if it is something that you have conviction around, put it down as a goal and build out some steps to get you closer to being able to execute on that and make it a reality. But I want the listeners to hear the stat that you presented because I thought it was very interesting on how differing generations of Americans are viewing and leveraging real estate within their financial plan.
Yeah. So the article that we have here, it's on a website called Keeping Current Matters. And the report is home ownership is a precondition of the American dream. And some of the stats that they pulled up from a survey that they had gone out and done is first and foremost was homeowners are 126% more likely than non-homeowners to view home ownership as a way to build wealth.
That is a pretty significant stat.
So what that points out is, hey, everyone who owns a home, and then even some of those individuals who don't own a home, agree that home ownership is a way to build wealth. And I think we've seen that here today. All of us have personal and emotional biases that lead us to make different decisions. You as a homeowner feel much more strongly about home ownership as a path to wealth, where me as a renter can feel that way, but there are a lot of caveats along that road that I'll pull up and say, well, this, well, that. What we've also found in this article is that millennials are 77% more likely than baby boomers to see a home as a primary way to build wealth. So what that points out to us is most individuals, young professionals, middle-aged professionals who are still in the earlier half of their financial journey, they feel that, hey, building a home is an indicator of success, of wealth, of the American dream. But interestingly enough, baby boomers are 98% more likely than millennials see their home not necessarily as a way to build wealth, but rather a way to pass wealth down to children and family. And that's where we start to see the narrative flipped a little bit. All of a sudden, hey, you're not a younger professional anymore. The home that you have lived in for the last 30 years, for many people, it's not an investment that they're ready to capitalize on and sail off into the sunset. It just continues to be the place that they live and effectively becomes the legacy that they pass on to their kids. And so that's where I think the summary is in my mind is a home is absolutely, or owning a home is absolutely a path to wealth. But true wealth owning something that you're proud of, that provides utility, and still having the flexibility to live the lifestyle that you want is very much about balance, right?
Absolutely.
Balance in what you're buying, how much home you're able to afford, and balance between saving, investing, and preparing for the future with money outside of the home that you own.
Absolutely.
And knowing that it's very challenging to have the best idea of what life's going to look like 5, 10, 15 years in the future, especially in the young professional world where, hey, many people, me as an example, I don't know where I'm going to live a year from now.
Right.
So it's hard to plan those decisions saying, hey, this home is going to be my ultimate path to wealth when I don't know if I'm even going to live in this area a year and a half from now.
Right. So to summarize that last point, one, there are multiple avenues one can take, families can take, business owners can take to building wealth, right? It's not a one size fits all. It's not evergreen. And there are opportunities at hand, but there are things that need to be considered. How long do you plan on being in this area? Can you continue to save with prudence and with, discipline, even after making this large purchase? Or if you're going to continue to rent, making sure that you have the discipline to automate your savings and saving that delta, the difference between what it would have otherwise cost you to purchase the property or a home versus continue to stay in your current situation. And my favorite is if you are going to take the leap and purchase a home and you still want to have roommates, well, why not leverage the utility of the property that you just purchased and create a quote unquote business opportunity out of it for yourself, right? Have someone else pay your mortgage for you, either 100% of it, which frees up the ability for you to continue to save, invest, and build liquidity in other areas of your balance sheet aside from the equity that's being built in the home longer term. And again, on average, the break-even point is going to be somewhere between 3 to 5 years. So if you are a newer professional, if you're relocating because of your job, if you're in residency or fellowship and thinking about, hey, I'd rather own a property versus, renting while I'm here doing training, think about that and go visit that calculator at NerdWallet. We'll put it in the show notes again.
So as Michael mentioned, there's no one size fits all whether you should rent or buy. But understanding your personal timeline, your financial foundation, your bigger picture goals, it becomes a lot clearer in regards to what decision may make the most sense.
And remember, owning a home doesn't automatically mean you're winning at life. And renting doesn't mean you're behind. It's all about intentional financial planning that reflects your current season and future vision and where you ultimately want to end up.
And if this conversation got your wheels turning, let's keep it going. Reach out to us at Genesis Wealth Planning or subscribe to Financial Fortitude for more strategies that help build a life by design, not by default.
Until next time, plan boldly, live intentionally, and as always, stay financially fortified.
Are you considering hiring a financial advisor? If so, be sure to listen to episode 1 of Financial Fortitude. In this episode, we discuss the reasons why many people choose to hire a financial advisor and highlight the key qualities you should look for in the financial professional you decide to work with.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Genesis Wealth Planning LLC, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. All scenarios and names mentioned herein are purely fictional and have been created solely for educational purposes. Any resemblance to existing situations, persons, or fictional characters is coincidental. The information presented should not be used as the basis for any specific investment advice. Michael Acosta and Brady are registered representatives and financial advisors of Park Avenue Securities, LLC, PAS. Securities, products, and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Consolidated Planning Group, Inc. and Genesis Wealth Planning, LLC are not affiliates or subsidiaries of Park Avenue Securities or Guardian. Michael Acosta's California Insurance License Number 0M50974 and Brady Hemmerly's California Insurance License Number 4353077. 7237198.11 expiration 727.